by the way, this is a new branch of finance, probably in the last 5 or 10 years. It's called, quote, behavioral finance, and which tries to take account of these kind of issues. And if there's ever been a time for behavioral finance, it's right now to get on top of that, because that's what we have. It's expectations that are driving things. So much for the current market reality. Let me get back to topic 2: why economists missed it. This actually was a lecture I gave to a group called the World Future Society, I think it was. The Austin chapter. The Austin chapter of the World Future Society. And it was called, let's see, what was it called? It was called, why are economists lost and conflicted? They asked me to come discuss that subject. And I thought it was an intriguing topic. And I volunteered. Why economists are lost and conflicted. My title is a little less intellectually, or excuse me, psychologically bound. But the question is, why are they conflicted? Or my way of saying is, why are they in such a state of consternation? And the reason I volunteered for that assignment of lecturing that group is that I had been intrigued over the last 18 months of watching the market meltdown and watching CNBC, particularly the Kudlow and company, and watching and listening to the incredible emotional outpouring of the guests. And virtually all of them were out there stating their own manifest destiny or their own idea of what matters. And Kudlow would try every once in a while heroically to throw a subject out. No one would talk about the subject. They'd all talk about their core beliefs. And this goes on for 18 months. There's no discussion. It's just reciting core beliefs. And so obviously there's, and with great consternation, shall we say. So the question is, well, what was driving this? And it occurred to me when I was asked to talk on this topic, it suddenly started to gel in my mind as to what was going on. Years ago, when I was a graduate student, I read something called, by Thomas Kuhn, called the Structure of Scientific Revolutions. And I think I have a page of an article that addresses it. First one, if only central bankers would hit bottom. And this article makes reference to the Thomas Kuhn theory, and it's a base, and it's an observation of how scientists or economists or academics in general, or scientists in general, are confronted with change, and what happens when they're confronted with change. When they went to school and spent their entire career learning one system, and suddenly the system changes. Basically, they get into a state of consternation. To give you a brief summary of what Thomas Kuhn has to say, and this one-pager really summarizes it beautifully. What he says is every science, and I don't care if it's a social science, a physical science, it could be physics, it could be biology, it could be climatology, it could be finance. There are academics who pursue this system because they have some interest in it, and in the pursuit of the system is to try to understand the structure of, and basically what all the sciences do, which is similar, is you try to break the system down into causal relationships. And for example, you could define a variable A that affects B in a certain way with a certain delay, and then B in turn affects variable C, again with certain delays. And if it's a simultaneous system, C comes back and affects A again, and then ultimately it affects the variable of interest D. So, and that's kind of, it could be a biology, it could be climatology, or it could be finance, or it could be economics, or lots of other sciences as well. So basically what scientists try to do is figure out that system. What are the variables and how do they relate to each other? And what he goes on to say is that in this whole pursuit of science, it's hard work and it's a lengthy endeavor. If you think about, I have a lot of undergraduates come to me and say, "Boy, I really find your lectures interesting. How can I do this for a living? This must be an easy job. You only teach 2 days a week. You must be on the golf course the other 4 or so." It appears that way from the outside. Frankly, it appeared to me as a student that way. And I followed one of my professors thinking the same thing. What these scientists do is learn the system. They spend their entire career, 30, 40 years, learning the system. What do they do once they get a PhD? It's kind of refine those little relationships from A to B. They try to refine what, is it 6 months or 6 months and 3 weeks? And what other variables might decide whether it's 6 months or 6 months and 3 weeks. So they spend a lot of time in the minutia of the links. But it's always within the confines of the system that they bought into. Because if you tried to come along and say, look, I think they got it wrong. It's not variable A affects B with a delay, and B affects C, and C comes back and affects A, and then affects D, which is what we're really looking at and most interested in. If someone comes along and says, well, there's another variable out there that matters, and that other variable is called variable E, and no one's looking at E. And so you start to try to introduce E into the discussion, and you don't get very far, because the academic journals don't want to hear about it, because E is not part of the paradigm. Those who are the esteemed members of the paradigm, and let me call them the paradigm cops, because they become the cops. If it doesn't conform to the system, we're not going to publish it. If it doesn't conform to the system, you don't get a grant. So somehow or other, if you come up with E effects, you're an odd, the probability of getting that ventilated to the profession is very small, and at best, if you show this with statistical levels of statistical certainty, that they have a difficult time rejecting it out of hand, it then arises perhaps to something called an anomaly. And an anomaly is something going on in the system, we can't figure it out. We're not going to throw the system out, but this is an unexplained thing that it's kind of hard for us to reject out of hand any longer. So you put it off to the side. So anomalies get put off to the side. And the way it shows up in textbooks is it's usually kind of a little box around it, like a cute little, for those of you who've taken econ, if you're, basic part of econ is if you have more spending by any sector. In total, if you have more spending, we tend to have more demand than supply, so prices rise. So usually inflation is associated with economic booms. But in the 1970s, we had a stagflation, where we had a recession and inflation. Well, this did not conform with A affects B and B affects C, which goes back, and it was totally out of the box. But they couldn't reject it, because it was in all the government statistics. So they didn't know what the hell to do with it. So they put it off to a side in an anomaly, and all the textbooks incorporated it as kind of a little box of kind of quiz, like this curious thing happened in the 1970s. And that's how they deal with it. So what we have then are hardwired systems, and the most you can ever get to is an anomaly, unless something happens where the effects come in where it's so overwhelming that it's undeniable. And that's what we've just been through. That's exactly what we've just been through. The system, which was supposed to operate in a certain way, and I'll tell you the way it was supposed to operate, ended up out of the clear blue sky on August 3rd, 2007, stopping on a dime. And it was like, it's almost like a comet came in from outer space. And no longer could they, call it an anomaly and put it in the box. So what happens then? And this is what Kuhn generally addresses in all sciences. Basically, the members of the science go into a state of shock. They're in denial. Again, behavioral finance. They go into denial. They go into shock, and they don't want to deal with it. And what ended up being the reason for the very, very loud on CNBC reciting the core beliefs. Because what was happening in the world was not consistent with their core beliefs, but they were not about to abandon their core beliefs. And that's basically what this first page says. And we saw it in living color for months going in time. So now what I want to tell you about is what the basic system they were betting on, what it was, and then how the paradigm changed and caught them so much by surprise. But the Depression, we had an unemployment rate of 20%. It was large. And it was the Depression starts, 1929, and it goes all the way till 1942. So that's 12, 13 years. It's a long period of time. We had deflation. We lost 30% of the banks in the country, which were not replaced, and the Fed did not step in with aggressive action, as they are today. So we had deflation. We had a deflationary depression, 13 years. People were giving up hope. They were looking for alternative solutions like socialism and communism, things of that sort. What saved us from that depression was the mother of all fiscal stimulus plans, World War II. We had a population of half of what we have today, so 8 million went off the labor market, into the Army, and we had mega government spending, and the economy surges ahead. In a few minutes, I'll show you just how far it surged ahead, and it'll impress you quite a bit. I have some decent graphs of it. And that was all fine and dandy. The war lasts from early 1942 till mid-1945, so that's only 3.5 years. I mean, we're already into this episode of ours almost 2 years at this point. But so the war concludes in mid-1945, and what hangs over the market, the financial markets and the policymakers, is the fear that now we're getting rid of the fiscal stimulus bill and the soldiers are coming back, we're going to go back to the same situation. We're going to have massive unemployment and deflation again. And obviously, 12, 13 years is enough time to rock solid make that expectation crystal clear, because not that far back, only 3.5 years earlier. So at that point in time, Congress gets concerned about this, as everyone was, but they took a legislative step, which is the Employment Act of 1946. It's actually called the Full Employment Act of 1946. If you can imagine, and you probably have a hard time imagining at this point, that up until 1946, we did not have any constitutional or legislative basis for the government intervening in financial markets and intervening in the economy to try to prevent recessions. Now it happens reflexively. Bad news happens. Oh, the Fed says this, the Fed does that. Or the president asks for a tax cut, et cetera, et cetera. Up till 1946, we had no constitutional or legislative basis for intervention by the government to quote, rescue the economy. So that's what the 1946 Act addressed. It's called it's called the Full Employment Act of 1946. It called for full employment, it called for, quote, full production, and it called for full purchasing power, which is kind of a backhanded way of saying no inflation. So what we then had on the books was this legislative piece that said that Congress, it was telling government and all its agencies and everything they do, we're supposed to have full employment and no inflation. And they had a few other things in there like no trade deficits and that kind of stuff. But a few other things that, some congressmen obviously threw in. But the main core of it was have full employment but don't have inflation. Now, this is new. This is totally revolutionary. And you can understand the urgency in 1946 when the soldiers are coming back and the war spending goes away. And we did have quite a recession as they were closing down the automobile plants that were taking over for war production. There was a total shutdown, and we had a really serious recession at the end of the war. So there was a lot of panic, actually. And actually, if you take a look at financial markets, the financial markets were priced for another deflationary depression. Equity prices were crushed, and debt prices, particularly government treasuries, despite the huge supply of them out there in the market from World War II, they were priced very, very high because it's a fixed income instrument that doesn't default, and that's what you want in a depression. So the prices were so high in treasuries that the yield was down to in the low twos. And this is on the 30-year, or the 20-year, I think was the longest maturity at the time. So it was almost, up to that point, it was the highest price and the lowest yield of treasuries. And it was really based on going back into the expectations of having deflation. And that's the instrument you want as treasuries. The yield on the treasuries, I think, is still the all-time low for the 30-year or the 20-year. Although I think our 10-year challenged, in November and December, challenged that 1946 Treasury yield rate. But anyway, the point is, the financial markets completely, totally expected us to go back into the Depression. There was no junk debt then. There were only corporate debts. There might have been fallen angels, etc. But prices were just crushed across the board.